All right, welcome everyone to today's Explainer. We've got a seriously fascinating mystery to dig into today. We're going to perform a complete autopsy on the recent $3.5 billion acquisition of Veris Residential. Whenever a company gets taken private at a massive premium like that, it always begs the same question. Did the buyers spot some hidden gem the rest of us missed, or did they just drastically overpay? To figure that out, we're going to step into the shoes of history's absolute greatest financial minds and run the numbers ourselves.
So here's our roadmap for this explainer. We'll start with the company snapshot and context. Then we'll evaluate the stock through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll apply some modern math with DCF and comparable models, and finally, wrap it all up with our synthesis and final verdict. Okay, let's dive right into Section 1, the company snapshot and context, aka the $3.5 billion question. To really set the stage here, we need to look at the raw financial reality of Veris Residential, ticker symbol VRE, right before it was taken private. It's a real estate investment trust, or REIT, focused on premium, Class A multifamily properties up in the Northeast. Solid business model, right? But look closely at these baseline numbers. Their public market cap was sitting at around $1.76 billion, and they were carrying a pretty heavy debt load of about $1.37 billion. Now, despite a trailing 12-month net income of just over $75 million, they were acquired by the Affinius Capital consortium for $3.5 billion. I mean, that price tag is a massive, massive premium compared to its public valuation. So our main job today is to figure out if the fundamental math actually supports that premium.
Moving on to Section 2, let's put on our Warren Buffett glasses and see how the Oracle of Omaha would view this company. What's really interesting about evaluating Veris under Buffett's criteria is the fundamental friction going on here. On the one hand, Veris has a moderate economic moat. Northeast Class A properties are historically highly desirable, and their operations are vertically integrated, which is great. But on the other hand, oh boy, Buffett would likely recoil at a return on equity of just 5.9%. And it gets worse. Their normalized net debt to EBITDA ratio was sitting at 9.0x. That is a seriously heavy debt burden. And as we all know, Buffett is notoriously allergic to highly leveraged businesses. Now, this number right here is absolutely crucial, $75.97 million. That's Veris Residential's trailing 12-month operating cash flow. In Buffett's world, we're always looking for owner earnings, which is basically the actual cash an owner can pocket after maintaining the business. Since the data shows their capital expenditures were effectively zeroed out recently, we're going to use the $75.97 million operating cash flow as our direct proxy for owner earnings. So, what's Buffett's final verdict? It's a hard pass. Think about it. If Buffett demands a conservative 10x multiple of owner earnings just to ensure a wide margin of safety, he'd only be willing to pay around $760 million for the entire business. That is literally nowhere near the $3.5 billion buyout price. For Buffett, the margin of safety here isn't just thin, it's completely non-existent. All right, Section 3, let's switch gears to the Peter Lynch lens, looking for growth at a reasonable price. Peter Lynch famously grouped companies into 6 specific categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. So he knew exactly what to expect from them. So we've got to ask ourselves, where exactly does Veris fit in? Well, looking at our data, VRE is definitely an asset play wrapped up in a slow grower label. Since it's a REIT, it's quite literally sitting on highly valuable real estate assets, but it's exhibiting incredibly slow growth. Analysts were only projecting a 3.85% earnings per share growth for the next year, and their recent quarterly revenue growth was a really modest 3.46%.
And that leads us to this number, 3.15. This brilliantly illustrates the ultimate Lynch red flag. It's their price to earnings to growth, or PEG ratio. For Lynch, the PEG ratio is the ultimate litmus test because it compares a stock's PE directly to its growth rate. Because Lynch looks for an ideal PEG ratio of 1.0 or lower to indicate fair value, a reality of 3.15 is a glaring, flashing warning sign. When you combine that severe overvaluation relative to its slow growth with the heavy institutional debt load we saw earlier, Lynch wouldn't even hesitate. He'd absolutely pass on this stock. Let's move on to Section 4, the Benjamin Graham lens. Time to see if this stock can survive the strict criteria of the father of value investing himself. We're going to run Veris right through Graham's defensive investor checklist, point by point. First, adequate size? Check. It passes with its $1.76 billion market cap. Dividend record? Pass again. They've been paying a steady 32 cents a year, giving a yield of 1.69%. But then the wheels kind of fall off. It completely fails earning stability because of previous net losses, like a negative 25 cents per share in 2024, and it fails the moderate PE test big time. Its trailing PE of 24.66 is way above Graham's strict maximum of 15.
Since it failed the checklist, Graham would already be out. But just to be completely thorough, let's actually calculate Graham's exact intrinsic value formula. We take the square root of 22.5, multiply that by the EPS of 77 cents, and multiply that by an estimated book value per share of roughly $12.31. Doing that math yields a fair value of exactly $14.60 per share, meaning there is absolutely zero margin of safety at its public market price, let alone that massive $3.5 billion buyout premium. Graham would walk away without a second thought.
All right, Section 5, DCS and comparable models. Let's move past the legendary investors of the 20th century and apply some modern quantitative math. Let's build out a discounted cash flow model. Now, since our source data doesn't explicitly provide a precise weighted average cost of capital, we're transparently assuming a standard 8% industry average to fill that gap, alongside a standard 2% terminal growth rate. Applying these assumptions to that $75.97 million in free cash flow over a 5-year forecast gives us a base case fair value of roughly $14 per share. And look, even if we get optimistic, tweaking the WACC down to 7% and pushing terminal growth up to 2.5%, we only stretch the value to $16.30. The math is just incredibly stubborn here.
And if we pivot to a comparable company analysis, the story really doesn't get any better. The contrast is glaring. Veris is trading at a massive PE premium of 24.66. Compare that to much larger, highly successful peers in the exact same space. You've got Avalon Bay at 15.16 and Equity Residential at 15.32. By traditional peer metrics, Veris is trading at a multiple that makes its competitors look like bargain bin finds.
Which brings us to Section 6, Synthesis and Final Verdict. Time to bring all these analytical lenses together. When we synthesize everything we've looked at today, a remarkably clear picture emerges. Whether you're using Buffett's owner earnings, Graham's strict formula, or a modern DCF, the intrinsic value of the business operations maxes out around $14 to $15 per share. Every single logical, earnings-based framework we threw at this confirms massive fundamental overvaluation. Honestly, this is a great reminder for your own portfolio analysis. When every fundamental framework screams overvalued, you need to tread very carefully. So based purely on operating fundamentals, our final verdict is a firm sell or pass.
And yet, that $3.5 billion check was signed, wasn't it? So I'm going to leave you with this provocative final thought. If every textbook valuation model, from Buffett all the way to modern DCF, screams that the cash flow doesn't justify the price, what hidden potential do the buyers see? Is this the ultimate asset play, where the raw underlying value of that Northeast real estate entirely eclipses the sluggish earnings on the income statement? It's a fascinating reminder that sometimes the true value of a company isn't found on the spreadsheet at all. It's in the ground it's built on. Thanks for joining me on this explainer, and I'll see you next time.